What's up, everyone? This is Nick Carter with a very special episode of On the Brink for you today. We have the one and only John Pfeffer on the show, who many of you will have heard of already. So for those of you who don't know, John is a storied investor and entrepreneur, a former partner at the private equity firm KKR, and who happens to have written, in my opinion, the single best treatise on Bitcoin and crypto asset valuation. So John's essay, which is titled An Institutional Investor's Take on Crypto Assets, began as a note written for himself so he could kind of clarify his thoughts on the topic, and later on he published it in December 2017. And it's not an exaggeration to say that it was a sensation. So if you've heard about the problem of velocity in tokens, it probably dates back to this paper where John succinctly lays out the issue. So put simply, he contends that most crypto assets, aside from those with emergent store value properties, will face an enormous problem as individuals will likely treat them as working capital and seek to minimize their exposure to these tokens, even if they're users of the protocol. This would mean that the token would likely fail to accrue meaningful long-term value, even if it did have a lot of transactional usage. So John also lays out a speculative valuation for Bitcoin, which is one of the more compelling models that we've seen. So in the 2 years since it was published, lots of industry participants have responded to John's paper and laid out reasons why they think the velocity problem doesn't hold. So we asked him about some of these rebuttals and we get his thoughts on them. We also cover a number of his contrarian opinions about the industry in general, including why he doesn't consider crypto an asset class, why he thinks there might be very little value capture at the token or corporate level, why banking the unbanked with crypto might be incoherent, how he thinks about position sizing in crypto, why he doesn't believe about diversifying within crypto, and why he thinks forks might actually be a virtuous feature of Bitcoin rather than a bug. So John has also quietly done a huge number of things to directly support Bitcoin. So we discuss his philanthropic efforts and also how he thinks about Bitcoin's patronage model. This is honestly one of our favorite episodes so far, and we really hope you enjoy it as well.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden, people start to worry. So out of this worry, we have something called the Bitcoin.
Welcome to the On the Brink podcast. I'm Matt Walsh.
And I'm Nick Carter.
And Nick, we are fanboying out. We have John Pfeffer in the room today. John, welcome to the podcast.
It's great to be here.
This is John's first crypto podcast. Not his first ever podcast appearance, but his first crypto podcast. So
Indeed.
We are incredibly blessed to have you on. Thank you for traveling to Boston.
It's an honor to be here.
And so we got to know John when we were at Fidelity when this paper showed up in one of our Telegrams chats, and it was the Institutional Investor's Take on Crypto Assets. It was back in, I think, December of 2017. And Nick and I started reading it and just said, wow, this guy is actually capturing exactly what we're thinking, and we were not able to articulate. So it's exciting to have you on the podcast, John, and we want to get into the paper. But first, why don't we... it would be great to just hear a brief introduction about your background and your career to date.
Sure. So I run my wife's and my family office, and I've been an entrepreneur all my life. Started out actually in the 1980s building a business in the video industry, and then in the 90s a tech company in France, Italy, and Spain that I sold. So the video business I sold in 1989. The tech company sold in Q1 of 2000, sort of at the peak of the tech bubble. Then I helped build KKR, which is a large private equity firm in Europe, and for about a decade. And we took the firm public, and I retired. Then I did something in oil and gas and sold that in 2012. And now we're building a traditional retail business in Europe. And then but I probably spend, 3/4 of my time investing. And what we try to do on the investing side is create a highly diversified portfolio of risk assets, private equity, public equity, and venture capital.
That's great. So with that background, I knew some of that when I started to Google you after this paper came out, and it really jumped out that, wow, here's someone that's been in traditional finance and has this really deep understanding of Bitcoin. So I guess the first question is just, how did you come across Bitcoin, and what's the origin story of how you started to care about this?
So I guess like a lot of people, especially, people with my background, I'd heard about it well before really digging in. What actually happened was I had the good fortune of chatting with Vinces Casares. Vinces is known as Bitcoin Patient Zero in Silicon Valley in Chile, and it was 2016, apologies. And I said, Vinces, explain this Bitcoin thing to me. And he did in very simple terms. He basically said, look, and I'm simplifying it even more than he did. He was much more eloquent, but in a nutshell, it was saying, look, that, money is basically a ledger for keeping track of what we owe one another. And Bitcoin is a much better technology for that ledger. It'll probably fail, but if it works, it will be valuable. And I said, well, I get that. And I saw it as a venture bet, like a lot of the other venture bets we make, it's something where I said, I immediately saw that while it would probably, I could see it would probably fail. If it were successful, it would be very valuable. And therefore there was a reward for investing in it. And it was literally a short chat, after which I got up, and as I was walking out, called our office and said, let's allocate X% of assets to Bitcoin. In 72 hours, we bought pretty much, all our Bitcoin. And and I remember that it was a funny chat because they were like, well, Bitcoin,
how do we do that?
We haven't really talked about that. And I said, guys, this is a ready, fire, aim investment. We'll make it. And we'll see what happens a bit. We can always adjust later, but let's just make it. And Vinces had said to me, look, just pick a number. Pick the number that you're comfortable risking, and then just buy it up front. So that's what I did. We just did that. And it was back in 2016. So it was while we're not by any stretch of the imagination OGs, it was reasonably early, certainly for folks like us. And but I did it with no more understanding than that. Then what happened, of course, is it started moving up, or it was moving up. And come January 2017, Bitcoin had risen. What in percentage terms was a lot. I mean, and so I was beginning to say, gee, this is growing and quite fast. And so I started reading about all of this stuff online, and so, you come across all this stuff, and it was, smart contract this and virtual machine that. And so we bought a bunch of ETH in January of 17.
You fell prey to the ETH
Well,
temptation.
yeah, I obviously I was unburdened by facts at the time. And so we bought a bunch of ETH and one or two other things, and then it kept going up. It was it was 2017, so the first few months of 2017, things were going up very fast. And come about May, I realized that I couldn't rely on what I was reading that was sort of, processed information on the internet about all of this, for a variety of reasons. One is it was generally not very thoughtful. And the other one was that pretty much everybody who takes the time to write about it, understandably, has some angle. They've probably decided that they quit their day job and they're devoting their life to this thing and so forth, and they may have a bias. So I said I'm going to have to go to what I would call primary information. So I went and I actually not only read the white papers, but also the Homestead documentation. And I approached it with my toolkit, which is a person with an economics background, an investor, and a business person, saying, "All right, why should these things be valuable, right? On what basis should they be valuable if they should be, and maybe how valuable could they be, and how to think about it." And so, you'd be 100 pages into the Homestead documentation of Ethereum, reading about how gas works and things like this. And then it was the summer of 2017, and again, all of this was going up a lot, and I was reading all of this stuff, and actually it was fun. I was on holiday with my family in Anatolia, in southeastern Turkey, in the back of a car, sort of all along the border, and it's amazing. It's a beautiful part of the world, and reading all this stuff, and had a notebook and was like writing my notes and thinking about all this stuff and trying to figure this all out. And then after that, we decamped in August to Beirut, and we're just hanging out. And so I wrote the paper in August of 2017 at the pool at the Phoenicia Hotel in Beirut, and it was really just, I wrote it as my memo to self, as right, how do we think about this, and what are we gonna do? Because again, what had started out as by that time, almost a year earlier, as a bet, a venture level bet, had grown on our balance sheet to a lot bigger number. And obviously the conclusion that I got to was, if all of this is successful, and that's the way I approached it, and I think that was more interesting. I find it a little bit boring to when you're investing in venture capital, right? You don't ask yourself, you do, but you don't dwell too much on what could go wrong. You ask yourself, well, what could go right, and what does that look like for me as an investor, and is that attractive? And so, rather than get bogged down in all of the reasons that one or any of these different protocols and cryptocurrencies, or whatever you want, crypto assets could fail, I said, well, what if they succeed? Will they be valuable? And I came to the conclusion. I said, well, if Bitcoin succeeds, it's going to be valuable by construction. And I came to the conclusion that pretty much all of these other things, the smart contract, so Ethereum, of course, but Ethereum and its competitors, and all the kind of DApp coins and whatnot, if they were successful, I didn't think they would be valuable. That was the gist of, that was sort of the conclusion of the memo. So we started selling all this other stuff and said we're going to keep our Bitcoin and sell everything else. And by January, I would say, January 18, we had sold everything else and kept our Bitcoin. And what had happened to the paper was, I'd written it on my own, and I was insecure about it. So like, well, maybe I've just maybe I've just made some kind of fundamental mistake of understanding. So I shared it with a few friends just as a private PDF. And so when you got it, I hadn't published it yet. It was,
I think, was it Patrick O'Shaughnessy might have been.
But who knows? What happened was, I shared it with a few friends, and I said, just, guys, just want, privately, what's your view? And then apparently they shared it. And next thing you know, you rang me up. And it was actually your call, Matt, when you called me saying, we've come across this, that made me realize that this clearly had gotten passed around, that finally made me say, well, you know what, I'm going to clean this up a little bit, because I'd written it more from, I hadn't really thought of publishing it. So I spent a few weeks, in and around like my day job, cleaning it up. And then it just happened that by the time I was ready to hit, publish, it was whatever it was, like the 25th of December or something.
Right. And that's when the market kind of turned.
Yeah.
Yeah. I looked at the dates. It was precisely 1 week after the exact top for Bitcoin.
Yeah. Well, there you go. Timing. Hey, but, the paper itself, I wrote it really in, it was sort of August, and we had by that time pretty much gotten out of everything. We were like still dealing with some of our fork coins and whatnot, right. But otherwise we've gotten pretty much out of everything. And then it went bananas, right? Because it got read a lot and like translated and all of that, which was unexpected.
So John, it's been 2 years almost. Well, 2 years since you wrote it, slightly less than 2 years since you published it. How do you think it's aged? I think it's aged very well, actually, although most of these debates have not been resolved, especially about Ethereum. But what's your assessment of how well your paper is aged?
Well, first of all, I'm honored that you think that. And I think it's, I'll tell you, I think it's aged well in the sense that I haven't felt the need to write or say much more about it. I think that there are some additional levels of understanding that, maybe, but fundamentally it's I think what I consider as an investor to sort of be the basis of an answer. And again, what I mean by that is I don't want to be reductive in terms of the potential for innovation, all kinds of new things to happen, but in terms of thinking about whether and why these things should be valuable and therefore, attractive or not as an investment, I think it hasn't fundamentally changed. Yeah.
So for folks who maybe have not read it yet, which we'll put it in the show notes, when you're explaining this paper and you're talking to other investors, how do you synthesize the core arguments of what you were laying out there?
I think the basic lessons or the basic insights of the memo that I certainly came to are that the one valuable use case in all of this is the most valuable use case by far is going to be a store of value, a digital non-sovereign monetary store of value. And why is this the case? Well, it's because if we again separate out non-fungible tokens, securities tokens, and focus on things that are functioning as currencies inside a protocol, they are they have to obey this equation of exchange, which is the value of the money supply. I should say the money supply, the number of currency units, must equal the GDP or the number of transactions times the average price per transaction divided by the velocity that the currency circulates. So what that means is that if people are willing to hold on to something, velocity will be low, and the consequence of that is that this currency will be valuable in terms of other stores, other measures of value. And if velocity is very high because people aren't willing to sort of store their wealth in it, but rather treat it as working capital, and we can get into that in more detail, then this crypto asset, this currency, won't be terribly valuable. And so that made me focus on what makes something a store of value, right? And it also made me and it also made me think about the different functions of money. Store of value being one, means of exchange being another, and unit of account, and help me parse out in my own mind the fact that the big value driver is the store of value driver, right. Because it's what drives velocity down. Means of exchange is not actually a terribly valuable use case. If something is impossible to exchange, it's going to be a bad store of value. So it has to be sort of be adequate as a means of exchange, right. But it doesn't need to maximize on means of exchange. And that was very contextually important at the time because we were in the middle of the fork wars,
right?
Where that was the battleground, was over, is it store of value first, means of exchange second, right, or means of exchange first, store of value second. And I came out as a consequence of this on the store of value first, school of thought, which is, what prevailed as well. And the unit of account, I personally think is not that important. I mean, let's take the easy to observe analogy of gold. It's terrible as a means of exchange. right? I mean, I don't know where you can spend gold in Boston, and we don't really use it as a unit of account,
Right.
But it's a great store of value. And so it made me just sort of focus on that. And then it made me think about what makes something a great store of value. And I said, well, it seems to me what really makes something, what's going to drive users to choose something as a store of value is going to be first and foremost, how, the character, to the extent to which it has characteristics which make it hard to be taken away.
Yep.
Right. And that's this notion of censorship resistance that, Bitcoin then and now clearly, it dominates on, right? And
I mean, not to interrupt, but I think it's actually broader than censor resistance. Censor resistance occurs at the broadcast level, right? Your ability to broadcast your message. But you also have seizure resistance, which is a function of the ability to conceal the asset and its lack of physical instantiation. So, in terms of the unseizability, this is, not to derail, I often think that censor resistance actually doesn't capture the qualities of the asset that well. It's just, incomplete almost.
I think fair point. In fact, what you're touching on is another. Let's go off on that for a minute. Security, in my mind, we talk about it often in this space as this kind of monolithic thing, right? When in fact, security can only be thought about in relation to specific threats, right? So I always think about the fact that, frankly, our Goldman Sachs account is more secure than the Bitcoin against certain kinds of threats, in the sense that if a Goldman Sachs employee makes a mistake, the money will, and wires to the wrong place, they'll recover it, they'll make it whole. If we make a mistake, we'll probably have some kind of, we'll be able to kind of put the toothpaste back in the tube. If there's an IT failure, also we've got to, we have all kinds of recourse and protection. If it's not going to perhaps happen to us, but we're talking about for the, from a conceptual perspective, if there's an order to freeze the account or to seize the assets, well, it'll happen instantaneously at no cost. And that's what Bitcoin, what you're talking about is I think, particularly excels at, is the fact that it's, it can't be easily seized in those particular cases. It's not necessarily more secure in these other instances. I mean, if you make a mistake, you can never get it back and so forth. And but that's a really interesting, unique quality that that again is analogous to kind of the role that physical gold plays in the economy right now.
Going back to what you're talking about with stores of value, so if this holds, and we think it does, how many of these crypto assets could be stores of value? Do you think that this is a world where it is a winner take all? Will there be a power law?
I think so. I think it is, just because it's, well, let's observe the fact that really gold, is unique in its monetary premium today, right? It has a huge monetary premium, and other metals really don't, or very, very, very little. There is another one, right, which is, say, the U.S. dollar, physical U.S. dollar, $100 bills, right, and so forth, or 200 euro notes. I actually think we're going to see the digital equivalent of that as well, and it will have both. That the digital fiat will be both used as a means of exchange and to some extent as a store of value, but it won't have the additional property of being non-sovereign, having a known monetary policy, and won't have this resistance to seizure.
And
right?
it's also very hard to make it independent of the issuer.
Well, exactly.
Yeah.
You're ultimately indexed to even in the case of the most pro-anarchic issuers like Tether, it's still not issuer independent.
Totally.
Presuming that the algorithmic stable coins don't work.
I completely agree. Now, I would argue that for many users, that'll always be okay. That's I think they coexist. I mean, I think that there's that's why we have $100 bills and 200 euro notes and gold bars, right? That society has a use for each of these things and uses them in slightly different ways. And I think that'll replicate itself, and that's okay.
Yeah. So if it's going to be a winner take all, one interesting thing over the years is that quite a few people in the Bitcoin community have sympathetic thoughts to people in the Monero community and projects, even like Zcash to maybe a lesser extent, but Grin, Monero, things like this. How do you view these privacy-oriented technologies? Do you think that this is a test ground that if they work, then they'll be incorporated into Bitcoin at some point?
The short answer is yes. Now there are some things that where it would probably be quite hard to do it, like say Grin, which would be you probably couldn't do that on Bitcoin, or at least it would be difficult. At least my understanding of how it works. But yes, I think although this the ways that privacy will continue to be enhanced on Bitcoin may also be different. We don't necessarily it won't necessarily be coming from say a Monero, but there'll be ways to improve privacy on Bitcoin, and I think that's clearly important. Well, maybe a comment. I mean, I think that one of the things I think about a lot on the store of value, when I think about store of value as an investor, is what's sort of the total addressable market, right? And we can observe in society today that the world has chosen to allocate about $3.2 trillion to, and I'm being conservative here, and I'll break it down to maybe it's a bit higher now because the gold price is up a little bit. So whatever, maybe it's 3.5 billion or 3.6, I don't have to trillion, to this non-sovereign monetary store of value function of gold. And just to be clear, how do I get to that number? I mean, people talk about this 8 trillion of total gold, and maybe it's a bit higher.
That's what
now,
I was going to say.
8.5.
Yeah.
But I personally disregard, and I'm just being perhaps a little bit conservative, all gold in industrial use. And
does
gold,
that include jewelry?
Well, no. So there's gold. So the 8 trillion includes industrial use, so the gold in our mobile phones and everything else. It includes jewelry, right? And it includes gold bars and coins and so forth. For the sake of my own purposes, I disregard both industrial and jewelry. I know that some jewelry could be seen as a store of value in certain cultures and so forth, and I get that. I'm not entirely convinced that Bitcoin is going to be competitive on those use cases. I mean, I know that, for example, if I, rather than, I don't know, buy my wife a gold necklace, I bought her some Bitcoin on a treasure wallet, that would probably be less well received. And I think that may culturally persist, notwithstanding, the fact that Bitcoin is functionally better on lots of other fronts. So I don't look at that. I look at the 3-something trillion of clearly monetary gold, right? This kind of undebatably, monetary store of value. And then I think about, well, which, by the way, most of which is sitting in central warehouses, and then they issue paper on top of it, so it sort of loses a lot of its seizure resistance.
There's a lesson in there for Bitcoin.
There's a lesson in there for Bitcoin for sure, and I think we will certainly see that with Bitcoin, and that will be analogous. So there'll be Bitcoin in custody, in custodial type arrangements, maybe even similar to gold. There'll be ETFs or other kinds of paper representations of Bitcoin, and that's okay. I mean, but it's not functionally better in some respects to say a digital, sort of a paper or digital representation of gold. Where Bitcoin is what could potentially create a much greater TAM is when it's self-custodied, right? I think that if you think about the addressable market at this kind of base level of this $3.5 trillion, most of which is actually in central, in some kind of custodial environment. Not all, but a lot of it is in some kind of custodial environment, and so forth. So that's TAM 1, right? But if you go beyond that, the potential for self-custodied Bitcoin to offer utility, offer utility to users above and beyond gold is significant. And so I could see that expanding the market, and substituting maybe other kinds of even non-monetary stores of value to some extent. Because frankly, it is a lot better. You can carry a lot more Bitcoin in across a border if you're a refugee on a USB stick than bars of gold. And so, I think that I'm not ideological about a lot of this because I've come at it as an investor, but I think that the interesting thing about from an investor standpoint of not your keys, not your Bitcoin, and all of that is rather than ideological, it's that it significantly expands what I think is kind of the uniquely addressable TAM of Bitcoin.
And in terms of the qualities where Bitcoin surpasses gold, maybe even more so than the portability, which is critical, is the assayability, the ability to verify
for sure
an inbound payment.
Totally.
Where that's actually, I would say, gold's biggest kind of pitfall is the fact that it's quite costly to verify. And that's why we have stuff like the good delivery rules in the London Bullion Market Association, whereby gold has to exist in an extremely specific way. And if it strays outside the supply chain, it has to be re-authenticated to re-enter it into it. Whereas gold or Bitcoin, it costs about $10, running a node to verify an inbound payment.
Right. And a slight, sort of a related point is that you can also know exactly what percentage of all Bitcoin you own, where you really can't do with gold.
Right.
And potentially one day we'll be able to evaluate the Bitcoin held by all the custodians and determine their solvency potentially, in real time, which is a bit of a pipe dream right now because none of them want to perform those attestations.
Right.
But you can do the informal audit. You can just try and characterize them on chain and find Binance and Coinbase and so on chain, which is a really nifty feature that virtually no other asset has, I would say.
Yeah.
Not where the consumer can at least account for that.
Agreed.
So John, if we do kind of live in this world where there's one dominant crypto asset from a store of value perspective, how do you think about this other bucket of innovation around smart contract platforms? I mean, one argument here would be that some of these things develop monetary premiums. I think we've kind of talked about that. Seems unlikely just from the power law perspective and from the MV equals PQ perspective. But how do you see this playing out? I mean, do you think that there's a world where a bunch of these things work from a technical perspective and they have users, but they're just not worth much?
Absolutely. Well, again, I think it's boring to get bogged down in all the reasons why things might fail, right? So I almost always start from the assumption that things succeed, and then I ask myself, what is it likely to look like, right? And this is venture. This is all venture. So you got to think of it as an optimist. So my view is that, as you said, so store of value is, I think, likely. We're just going to have, there's going to be huge incentives for us all to sort of agree on one, and that one is going to be, that choice is going to probably be driven, as we said earlier, by Caesar resistance, relative Caesar resistance, censorship resistance, and so forth. These kinds of characteristics that, by the way, Bitcoin prioritizes and excels in by orders of magnitude, right, over anything else. In parallel, I think that let's assume that having these sort of general purpose smart contract protocols turns out to be useful. My I don't think that changes the fact, and so they're useful. I think that users are going to look at that and say, fine, this is a useful thing, right? How do I want to behave towards it, right? In order to use this thing, I need to acquire resources on the protocol. And in order to execute whatever operation I'm trying to execute. In the case of Ethereum, the way you do that is you pay miners gas for your, for the computations that you want to carry out. And today, by convention, you buy gas using ETH. Doesn't actually technically have to be the case, but that's the way it is today. And
although according to the protocol, it does, right?
It does. I mean, right. But I don't know that. I mean, it would be relatively easy to change that. And I think, and by the way, I think it's quite clear that the Ethereum community and the Ethereum Foundation have, no interest in.
Well, they've been quite specific in that they want to heat off any notion of economic abstraction,
because
right, for good reasons, I guess.
Well, certainly, given the fact that they all own a lot of ETH, being the main one.
Well, and also because they identified the problem, basically.
Right. But when and so, fine. But let's not get bogged down in that. So fine. So you're actually paying gas, and it just so happens that to buy gas you need to buy it with ETH. But users will ask themselves, I think, okay, am I going to keep large quantities of ETH on my balance sheet, right? Or not? And again, I think if it's not the thing that they choose as their, main store of value, I think they're going to gravitate towards treating it as working capital. And what working capital, we have working capital. It's everywhere in our lives, right? It's the food in our cupboards. It's the fuel in our car. It's the cash in our pocket. And we don't, our behavior, and I'm talking about consumers there. Companies have the same thing. Walmart has warehouses full of, cornflakes and televisions, right? And consumers intuitively and companies very deliberately seek to minimize their working capital because they don't want to tie up assets because it has an opportunity cost to do that. So, it's not like Walmart has a good quarter and says, we're going to go buy a few extra warehouses full of cornflakes, even though cornflakes are useful to them because they sell them, nor are they, saying we had a good quarter, so we're going to store up, we're going to store up a vast amount of electricity, even though they use electricity in all of their stores. On the contrary, they have teams and teams of people whose very existence is defined by driving that working capital down and figuring out how to do it. And it'll be remarkably easy to do that. In
it's
protocol
digital,
land,
right?
It's digital, yeah. And it'll be increasingly interoperative and so forth. So it'll be and as they decide to effectively acquire, instantaneously what they need to execute what they're trying to do, velocity will go through the roof. So right now, and people I think tend to get a little. Then they take this idea and then they go and they look at, and they say, well, but right now, these things have value and, velocities are X or Y. But let's remember right now, no one's using much of any of these things in any volume or scale, right? I mean, the amount of usage is very low in terms of, anything other than speculative use.
I'll agree with that. I think that a lot of the DeFi use cases are essentially levered long ETH.
Yeah, that would be the main thing people identify. And Yeah, DeFi is probably the biggest use case, aside from just moving money to exchanges, which is actually the main thing that anyone uses crypto for, is settling, in between individuals and exchanges.
Right.
But then, I don't know. I mean, I do certainly believe that there is some sort of crypto economy out there, marginal as it may be, but I believe that it exists. It's just very hard to isolate it, because if you are an active participant in the crypto economy, you're probably part of the black or gray market. You might be running an export business between Russia and China. That's something I've heard anecdotally. So you do not have an incentive to declare that activity. So it's very hard to identify it, basically.
Perhaps, but I don't know. Fair enough. And my sense is just looking at daily average users across applications on Ethereum, it's pretty de minimis. And therefore, today, I think that looking at current statistics are just a reflection of speculation, which I believe is generally misinformed. I think that people own a lot of these things without having really thought through why they're going to be good at capturing value in the future, even if the thing that they think they're investing in is successful in terms of both technology and user acquisition. So let's be optimists. So let's assume that they are successful technologically and in terms of user acquisition, and the amount of real-world economic activities being conducted on these protocols increases, right? As that happens, economic agents, users, companies, consumers are going to be, they're going to be overwhelmed by powerful incentives to be efficient in their use of these crypto assets and the capital tied up in them. It's kind of nuts to imagine that we're let's imagine that we're in this, we're a decade down the road and in this, world where protocols are everywhere, right? And everything's on, everything's been, moved into these protocols, and companies are storing vast amounts of many digital assets, on their balance sheets, and consumers as well. They've got, by the way, given that most consumers have little or no savings to begin with, are tying up, what little capital they have across all these different things, is no more sensible than it would be for them to, say, well, I just got my paycheck, so I'm going to go and, buy a bunch of AA batteries because I might, they do the opposite. They're trying to minimize the amount of capital that's tied up in all of these different things. So they will, and it's going to be very easy. So velocities are going to go very high. Another question, we'll come maybe a little bit later to how successful they'll be and so forth. But I think if they're successful, they'll treat them as working capital. Velocity will be very high, and the consequence of that is, notwithstanding, almost any level of economic activity that you want to assume, these, the network values will be very low, certainly very low compared to their current valuations, which I think makes them really bad investments.
So then the key question for you for why these might actually accrue value is, what reason would economic entities have to stockpile these assets?
I can't think of one.
Well, the obvious one is because they expect it to, or they believe that it is a monetary good, right? That would be the exception.
Sorry, I mean, obviously, but I'm sorry, I was thinking more broadly. Yeah, I mean, I think that's, of course.
You have to make the case for there being an exception to this point, right?
Well, I do, but I think that tends to be, back to what Matt was saying, that's probably going to converge on one, and by convention, and that choice will be driven by these factors that we've talked about: seizure resistance, and whatnot. By the way, if I had to guess, what the world looked like in 10 years, I think there's a really good chance that we're going to have a monetary, non-sovereign store of value, and I think, as you know, Bitcoin, I believe, is by far the leading candidate. I think there may be multiple smart contract protocols, and I say may. We can get into that later because I do have some doubts. But let's just assume for the moment that there are. But I don't think that they're going to have very high network values, even if we assume that a lot of the economy migrates to them, because I don't think that users are going to kind of store these things up. I do think digital fiat in some shape or form, and it may, there's a few different things that could be out there. Maybe it's this synthetic central bank digital currency, stuff that the IMF talks about and so forth, will be like a big thing. And I think that'll be big in both means of exchange and store of value. And I think there's actually a good chance that in particular for like companies and whatnot, that they might gravitate towards, storing their retained earnings, if you will, in, I think it's rather intuitive, in digital dollars or euro or yen, as opposed to say Bitcoin. In the same way that today they have treasury in these currencies, but they don't have gold, right? So I think that's probably going to replicate itself. And then there'll be other things like maybe there'll be securities tokens, maybe there'll be non-fungible tokens. But again, I don't think that consumers, whether consumers or companies or government agencies and so forth, I just don't see them want to store a lot of these different things, which is one other point. As a consequence, I don't think of this as an asset class, any more than everything that you have in your cupboards at home in your garage represent collectively an asset class, right? I mean, you have you have stuff, you use stuff, but they're not investments. They're not investment assets. You don't run around trading them against one another in any kind of structured way. So I personally think, when all of this, when this kind of matures as a technology, we're not going to be trading crypto assets as like a thing. We're going to, Bitcoin, if that turns out to be the dominant store of value, will be a macro tool in the same way that gold is a macro investing tool, and it will also be something that individuals use in all kinds of different ways to store their value, and the rest of it is going to disappear into the woodwork. It'll be it's not like how much time do you spend acquiring the electricity that you use. You don't sit there, you're not probably sitting there as an individual saying, oh, the rate's lower, and so I'm going to buy electricity now because it's midnight and I was using electricity. And you don't. It just happens in the background.
Although there are entities that do trade electricity wholesale.
Entities do, but and that'll be, again, I'm saying it disappears into the woodwork. Meaning, it'll probably be. I'm assuming that we'll, the apps we'll have on our phones or whatever devices we're using in 10 years. Will be, if to the extent they need to work, interface with a protocol, will just automatically sort of buy whatever resource is required on the protocol in the instant it needs it, and it'll do it in an optimal way. And by the way, if there are two protocols capable of doing the same task, it'll instantaneously figure out which one is the more cost efficient one, and choose that one if that opportunity, if that option exists.
And therefore capturing value at the company level as opposed to the protocol level.
Or frankly, just evaporates into consumer surplus.
Right.
I kind of think that the interesting thing about this technology, again, jury's out on how much surplus it really generates, but it's uniquely bad at value capture. One, because these currencies, because they circulate, they have this velocity problem, if you will. And problem is not a problem. It's not a problem in the sense that it's massive economic surplus. That's great.
It's a good problem to have.
But you don't capture it, right? And then secondly, by the way, if you do kind of create artificial methods for trying to create some rent around these things, that is undermined by the fact that it's open source software. And then you get into competing protocols, you get into forks and so forth, which is, you can't measure today, again, because no one's using this stuff really. I mean, they're not, they're using it for speculative purposes, not using it to go do something in the real world in any real material volume.
Right.
So I was trying to summarize your core thesis prior to this podcast in my preparation, and I I boiled it down to two things. So capital is costly, and nobody wants to, as you describe, nobody wants to allocate working capital to, some generic protocol, or they just try and minimize it, generally speaking. And the other prong being that it's extremely difficult to establish a moat or induce anybody to use your protocol, even if there's some interesting economic purpose there, because you can't really force anybody to use your protocol due to the open source nature. So that's why the kind of taxi medallion analogy doesn't work, because there's no government in place to enforce the local monopoly that the taxi drivers have.
And the more, and what happens is the more these things are used, the greater the incentives will be for users collectively to figure out a way to break down the rent seeking mechanism that you've created. And it's also, by the way, a little paradoxical. I always laugh at, it's like there's this, and this is, people don't talk about it quite as much as they used to, but it's this kind of, we're going to bank the unbanked and all of this. And it's kind of like, yes, here's how we're going to, there's sort of this, we're going to, our mission is to help society, and the way we're going to help them is recruit them to use our protocol and make them pay us for the privilege of buying our bags so that we can get a nicer car and a bigger condo. If you create these barriers, you make it arbitrarily costly to use these protocols, users will figure out a way around them to the extent they need to. Again, let me just be clear. People sometimes also, when I wrote the paper, maybe I can understand it. I talked a lot about forking because that was obviously a big thing, and at the time I was writing it, and it was a big. But the main reason why these things are bad at value capture is velocity, right? That's the main thing. The forking only really becomes relevant, forking or using competing protocols, as kind of it's if necessary. It's like if somehow you arbitrarily create a mechanism for driving, for holding velocity down to arbitrarily drive up the cost of resources on the protocol beyond what they need to be to actually do the thing that has to be done, the computation or whatever, then it'll be hard. It'll be relatively hard to sustain that, because it's going to be pretty easy to copy it, and copy it, fork it, whatever. I'm not sure. We may not end up ever seeing much of that because velocity may already solve it, right? And so I don't want people to think that it's all about the forking. I'm just saying that undermines your ability to solve the velocity problem artificially.
Right. As you're talking, I'm thinking about potential arguments that you must have heard when you published the paper. And there's certainly something that we hear a lot, which is, it's early. We don't know what this innovation potential will unlock. If you think about the internet analogy, it wasn't just a more efficient way to send letters. Certainly there was value destroyed in newspapers, but there are new things built on top of it. So I guess from your perspective, what's the most cogent rebuttal or counterpoint to your paper that you've heard, or maybe have you heard any?
Well, look, given that I'm just an investor, so remember, I don't approach any of this ideologically, and I also, because we're just investing our own money, have zero agenda beyond making the right decision for our own money. I like to think that I'm predisposed to be pretty objective and open to changing my view if that seems to be the right thing to do, and I haven't. But again, I haven't really heard anything that persuades me that there's that basically I'm wrong in this, and what I mean by that is in the sense that really what matters here is which thing the world decides to treat as a store of value. Now, The next argument would be, which you hear a lot of, is, well, if it's useful, it will become a store of value. And that's just not true. We don't store value in electricity, and yet it's the most useful thing on the planet. It's all around us all the time, and it's
oil,
everywhere.
right?
Or oil, but I'm exactly. So, yes, you might have inventories of oil, but that's, again, working capital for the most part that you do because you have to, because maybe the supply is unstable.
And the stores of value we have are actually not that useful. They just sit in vaults.
And they're totally not useful. I mean, if gold, for example, if gold has some industrial use, but if tomorrow it ceased to be treated, if people ceased to see it as having money character, representing money and so forth, and its monetary premium went away, we would have decades of gold available, for industrial use. And of course, therefore, the value of gold would collapse below what it would, what it costs to extract more of it, probably forever.
So I looked at some of the responses actually.
Okay.
Because I tweeted about your paper and then I said I haven't seen a good response.
Okay.
Which is what you just said. And then some people said, "Oh, actually, I wrote something that was a really good response."
Okay. Yeah.
And so I read some of those responses. So I think I can put them into 3 buckets. Actually, one of them is my response. So I'm trying to steel man the the opposite, because we don't want to knock down straw men here, right? So the first one is, velocity empirically is low, so that would be just to claim, well, you're factually wrong. Velocity in practice is pretty low. So I guess your response to that is, well, actually, we haven't reached a mature state at all. So it's far too early to really look into the data here. Which I think is fair. The second one is, obviously, we can introduce so-called velocity sinks. And I think the notion of velocity sinks emerged conceptually in the industry as a direct response to your challenge of creating the problem of velocity. Yeah. And that became an obsession almost mostly in 2018. And then 2019, people almost stopped talking about this for some reason. If you challenge any of the investors in the new smart contract protocols about value accrual, they just don't even broach the subject. They just assume, or maybe they just plan to get their exit at the public sale, and so it doesn't matter to them. I think actually that's the answer, is that this question does not matter to them because they are not planning on holding this thing for the long term.
Well, they're going to hire someone for token economics. I think that's the other thing
but so I think the Steelman one is that you can just introduce a velocity sink, and staking is the most commonly referred to one. So why don't we talk about staking a little bit? You don't consider staking to be a compelling velocity sink. I actually have my explanation for why not, but I'm also curious to get yours.
Well, I'll give you mine. I want to hear yours. I mean, so first of all, it's all. I mean, there's a whole list of issues. One is the fact that if you have a proof of stake mechanism, then some, let's say, half of the units of currency are staked and half are not, then what's going to happen, of course, is that the half that aren't are going to suffer the cost effectively through all of the inflation in the protocol being borne by them, to incentivize to remunerate those who are staking, and that creates even more incentive for the non-stakers to not hold the thing, right? So the more you stake, the higher the velocity of the remainder. The greater the incentive for the velocity of the remainder to go, to increase, and it's average velocity that ultimately matters across the thing. Number one. Number two, it doesn't tell us anything about what the value of the crypto asset should be, right? Because it's measured in terms of the crypto asset. So if in a scenario where 20% of ETH are staked, and therefore if you model it out, it's supposed to get a return of 5% in ETH, that relationship is true whether ETH is worth $1,000 or 10 cents. So fine, it just doesn't tell us anything about value. Thirdly, I think it doesn't proceed from I can earn a return, therefore I'm willing to hold the thing. You have to first be willing to hold it before you want to think about return. And the analogy is you can really, you can get, if you want to convert all of your savings to Argentine pesos, you can get a great interest rate right now. And yet Argentines do everything they can to convert their pesos into dollars and not hold the pesos. They have to first see it as a store of value, and then you can think about the economics of holding on to it and the returns you might get. So you don't create something that in of itself is viewed by users as a store of value by creating a return on it. And why would they treat it as a store of value? It comes back to seizure resistance and censorship resistance and these other factors, which either you prioritize, which is what Bitcoin absolutely does. Bitcoin says this is what we're going to prioritize. This is all we're going to do. So they have a better chance at achieving it than something that's trying to say we're going to be something completely different. And oh, by the way, maybe by accident, will be also treated as a store of value. So for all these reasons, and then it's one other thing, which is if velocity is high, intriguingly, you could have a reasonable amount of seizure resistance in a high velocity proof of work protocol, because you could have such a high level of fees that high level of fees divided by high velocity equals a value of a network that is low measured in, say, dollar terms, and it could actually provide a reasonable level of seizure resistance. If you're in proof of stake world, a low network value means you don't have security. So I actually think that
So there cannot be a equilibrium at a low value proof of stake system.
Clearly not,
because it can't provide its own security.
Right. So I actually think exactly, and so I'm TBD if anyone actually if say Ethereum actually manages to transition to proof of stake. But I would wager that if they do, let's say if they do, and if Ethereum continues to actually be successful in terms of acquiring users, in terms of real economic use, that actually what's going to happen is, and therefore it's going to be treated as working capital. So velocity is going to start rising. They're going to, if they're going to survive, they're going to have to go back to proof of work in some future, right? And this could take years and all of that. And then maybe it's sustainable at some level, maybe not.
So I like your reasons. My main reason is I see this fallacy of presuming that some entity coming into the network and holding the coins for a non-zero period of time actually reduces velocity.
Right.
Because velocity is so they treat velocity as homogeneous in this model.
Right.
But I would say it's extremely heterogeneous. So if you look at the use cases in DeFi where you have big whales that are like taking out loans on Maker, basically locking up a bunch of ether, which is the context where this argument is frequently made. You look at the value locked in DeFi, for instance, and then the implicit assumption is that will cause Ether's price to appreciate through a reduction of velocity, right? So that's the very common response here. That doesn't really change the composition of velocity because those coins were held by long-term holders anyway. They're not inducing new money to come into the system. And we can actually we can verify this because if you look at the big whales that have CDPs open in Maker, some of those coins trace back to the Genesis block. So those are entities that were long-term investors in Ether anyway. They're just converting their basically inert Ether in context 1 to inert Ether in context 2. But that doesn't mean that you're inducing any third parties to come into the network and lock up capital.
Correct. Yeah.
And then the other reason I think this inducement wouldn't occur would be because I don't think stake yields would be sufficient to induce anybody to come in and stake, basically. So you say, well, this is not how asset allocation works anyway, so which is a good point. But I think just practically speaking, the stake yield, quote unquote, would just converge to essentially the risk-free rate.
Right.
So maybe, plus a premium. But I don't see how a stake yield would actually be super attractive because it's like if the yield spikes or something, arbitrageurs would just come in and allocate some capital perform essentially the equivalent of a carry trade and drive it down.
Right.
So, and I don't see anything inherently risky in stake networks per se, in the same way that a corporation is risky with all these uncertainties. The process of staking is pretty mathematical and straightforward. So I don't see why a stake yield should be 8% real or anything like that. I think it would be close to the risk-free rate in virtually all cases.
Right.
So I don't think this hypothesis that the existence of staking would be a sufficient inducement to allow new entities to come in and allocate to the protocol long term. I just don't believe that.
Fully agree. Just like, the fact that Argentine interest rates are high right now isn't inducing many people to go and, load up on Argentine pesos.
Yeah, and so people sometimes they don't understand the problem of velocity. I think it makes a lot of sense if you think about it in terms of normal currencies.
Right.
So the Venezuelan bolivar, people need exposure to it. So it has great utility, right? Because you have to use it to buy food.
Right.
So there's tons of utility. You die if you don't use it. But they basically hold dollars, often in offshore Zelle accounts, stuff like that, or physical dollars, and then they turn it into bolivars some way through an FX broker on the street or something, at the point of sale, so they can have the tiniest exposure possible to bolivars. Then they buy, bananas or whatever. So they want to have as little exposure as possible to it, and that's basically that's the problem of velocity. And it's like a self-fulfilling cycle, because if you enter this inflationary loop, people's desire to entrust their savings to a certain currency gets eroded more and more. So that's why you have these hyperinflation events, because all of a sudden people collectively lose faith in the currency.
Exactly.
So it feeds on itself. It's like a positive feedback loop.
You're making a really important point. People forget that it's not enough to even have a stable money supply to prevent hyperinflation. You can have hyperinflation with a stable money supply. If people don't want to hold it, if people aren't willing to store their wealth in the thing, right? And that's what happens, behaviorally in a hyperinflationary environment. Now, it's also true often that they're expanding the money supply. But if you froze that, right? But people's behavior was still that they got paid on a Friday, and they went straight to the shop and bought everything they could to get rid of the money as fast as they possibly could, which is what tends to happen in a hyperinflationary environment. And the merchant did the same thing, and on down the line, you could have hyperinflation with a stable money supply. It's not enough to say that, well, the money supply is relatively stable or completely stable if people don't want to hold it. And then you have to again, you kind of come back to the question, okay, so what makes people want to hold it? Well, it appears to be other factors, to your point, Nick, than sort of some kind of broad utility, right? They're focusing on something else, and we've said it before, but thinking, we're talking about it being seizure resistance and these kinds of factors.
So the final steelman I had for how velocity sinks might come to occur, and this is my own steelman, I haven't really seen this written about much, would be that crypto assets would be particularly useful for contracting, as in creating economic contracts. People call them smart contracts, with the asset itself being the collateral that is locked in that contract. And these contracts by definition have a non-zero term, of days.
Right.
So the idea there being that, for instance, Bitcoin couldn't sufficiently enable that form of contracting. And if this became super popular as a unique use case on Ethereum or some other smart contract platform, protocol, then the lockup effect would actually be meaningful in that case.
Yeah. I guess still though, right, for people to want to do that, right, that's really just another version of them wanting to store their wealth in that unit of currency, or that
Right.
type in that
For the same reason that financial contracts are denominated in dollars.
Correct.
Trade
and
is
you can,
denominated in
you know,
dollars.
given, I actually, I think that we're going to have digital fiat, and I could very well, I mean, we have it already with Tether now on Ethereum. Maybe some of that is built on top of a public blockchain like an Ethereum. People are, economic agents are going to denominate the contract. They're going to be very intuitive and natural for them to denominate the contract in, say, digital dollars. Now, the computation is conducted on, say, the Ethereum blockchain, and yes, some gas will be purchased, but they're not going to stock up on ETH at any moment in executing that contract.
So the violation of this unity property, the introduction of a foreign asset onto the protocol, essentially means that you can denominate the contracts in whatever you want.
Right.
Do you think that that's a bear case against Bitcoin too? I mean, or would you say Bitcoin doesn't rely in any way on this notion of contracting?
Bear case just in what sense?
Well, because Tether, used to exist exclusively on Bitcoin, now only in part. But empirically speaking, Tether and the various stable coins actually have far more usage per unit of market cap than a generic cryptocurrency.
Right.
They have tons of usage.
Right.
So they're sort of quite liquid, basically. Don't you think there could be a case where it emerges that stable coins on top of public blockchains was actually the thing that people wanted all along?
Listen,
as opposed to, for instance, Bitcoin exposure.
Well, I think they're going to coexist, right? Or at least I think it's highly likely they'll coexist. And my evidence would be that gold and dollars and euro and yen and so forth coexist today, and there's it's fairly analogous, right? So I certainly think, for example, we talked about earlier, I think that companies will, the likelihood that they're going to actually say own a bunch of Bitcoin is as low as the likelihood they're going to own a bunch of gold, an operating business, and that's okay. I mean, I think M0, so like actual like physical money, so you take away any multipliers through the banking system and so forth. Globally, the number I have in mind is say 5 trillion.
Yeah, it's not much. I mean, physical banknotes.
Physical banknotes, which to me is the analogous thing to say a Bitcoin, right? Sort of the 21 million Bitcoin. Right?
Have you seen the base money analogy that the Crypto Voices guys do, where they include banknotes and also bank deposits at the central bank, but none of the other commercial bank reserves?
Right. And what does that add up? What is that number?
By that token, Bitcoin is the 11th biggest.
What's I'm just curious. What's the total value of? Do you know? Okay,
putting me on the spot here.
No. I was just curious because
like 7 trillion.
Okay, so let's say it's 7. I'm just trying to. We should all check that later. But I mean, let's just say for the sake of discussion, it's 7 trillion. So yeah, that's kind of an interesting. That's an interesting indicator whether it's 5 or 7 trillion. We said earlier that gold, like what I think is which is gold, which is clearly monetary, purely monetary, is say 3.5 trillion. Give you some sense of orders of magnitude, right? And I think as a baseline, that's a good starting point. Society has sort of organically decided that it needs 5 to 7 trillion of these, digital fiat. Physical fiat and central bank deposits. Apologies. A good chance that that'll be similar, maybe even slightly less, because money is a suspense good, and so as you have greater efficiency in an economy, you arguably might need less of it. But okay, let's not get too distracted on that. And then gold is 3.5 trillion, so that's sort of an obvious immediate addressable market. Could you expand that addressable market? We talked about that earlier. Yeah, you might be able to, because it's more functional than gold in many respects. But I mean, I think in terms of orders of magnitude, those are probably useful guideposts, and that's fine. So is it a bear case? I don't know. I mean, I think that it's entirely natural that a lot of that a lot of contract smart or otherwise, or in fact the bulk of them will probably still be denominated in fiat terms. in the same way that we don't see a lot of contracts today denominated in gold terms.
I have this kind of a weird thesis that I think Bitcoin is actually a powerful ally of the dollar. People see it as an enemy of the dollar. You know, they people in Congress say that it corrupts America's, you know, monetary privilege and so on. But empirically, stable coins get issued not just on Bitcoin but on Ethereum too, and I see no signs of that stopping because people clearly demand, especially non-Americans, they demand exposure to dollars. In particular, in a sort of a bearer asset, public key way.
I agree.
So I think that's only going to continue and accelerate. I think the market cap of all stablecoins might exceed generic cryptocurrencies at some point in the relatively near future. And also, a high-powered savings instrument like a Bitcoin predates on the weaker sovereign currencies because it gives people in those countries a very easy exit ramp. But the dollar is considered to be the strongest one. So, you know, what I tend to say is like Bitcoin is hostile to the 30% of the worst currencies in the world, but not, you know, the dollar. So I see it as a kind of a potentially strategically useful technology. As far as
I think it's complementary. You know, I think probabilistically, in terms of most future, you know, most possible futures, is complementary, not competitive.
So John, switching gears a little bit here. So you have become kind of known as a Bitcoin patron of the arts, so to speak. So you're sponsoring some open source development. So talk a little bit about how you see the responsibility of investors and just, you know, why you do some of the work you do, and also just what you're sponsoring.
And I told earlier kind of how I got into Bitcoin, and in particular, you know, we lived through and was writing this paper in the context of the whole SegWit 2x debate and the fork wars and everything else. And when in the aftermath of that, in December of 2017, our investment had performed very well, right? And two, as I dug in and really developed my understanding of all of this and thought through my own views around the, you know, sort of the fundamental battle lines of the fork wars and so forth, was that it's, you know, we just became very sensitive to the fact that this is open source software, and it's something that all of us who have a stake in it should, you know, try to think about how to contribute to it, right? And we all have different ways that we can contribute. So, you know, I can't code, so the good news is that I won't be making any commits anytime soon.
You don't have to code, actually. You can actually just suggest random things. You know,
suggest random things.
Don't call them Satoshis anymore. Things like that.
There's been grammar mistakes which have been corrected.
Well, maybe I could. My grammar's good, you know, that's one way. Obviously, you know, contributing to decentralization of mining is a way. Running a full node is a way. You know, some people you know, actively communicate you know, much more than I do, right? And there's lots of ways to contribute. What I chose to support development and, you know, Bitcoin core development, because I became very sensitive to the fact that was, to me, really the most important piece of all of this, and specifically trying to ensure that, or just trying to contribute, I should say, that, you know, be one more no strings attached source of support to help ensure that there are resources for development, and that they are decentralized. You know, that there are many different sources of support. And to be clear, there are others who you know, provide much more support than we do. I mean, you know, in particular, obviously Alex Morkos and Suhas Daftar and you know, and all the folks at Chain Code. We've seen what the fantastic support coming from Jack Dorsey and the folks at Square Crypto. Obviously, Blockstream, the folks at MIT DCI, and hopefully, and a number of companies. Zappo has developers, and other and other companies, and I'm sure I've forgotten to mention many. So I just we just felt that that was our priority, was to focus on supporting development, and we wanted to do our bit because we have a stake in all of this. And how do we do it? So the very first thing. So this was December of 2017, and I'm on some listserv, and Adam Back sent an email saying, suggesting to the group that it would be a good idea to have a sort of a great scaling initiative, and with the focus being on, given that the outcome had been not to increase block size, was to help remedy the inefficient use of block space that was particularly egregious at the time, and by propagating more efficient block space use methodologies by exchanges and companies and so forth who are the large users, and in particular to try to have some a couple of project manager type resources and so forth dedicated to that. And sort of offline, I emailed Vinces Casares and said, "Hey, Vinces, why don't we offer to fund that as a way to help?" Right. This was kind of my first initiative, and I said, "This seems like really important." And Vinces says, "Great idea. Let's do it together." So I kind of emailed back to the group. Vinces and I are prepared to to offer sponsorship for this and so forth, and which great, and then sort of crickets, because it actually depends on the person or people to do it. And then a couple of months later, John Newberry at Chain Code raised his hand and said that he wanted to lead that initiative, and Alex and Suhas very, very kindly said great, and obviously allowed him to sort of encouraged him to focus his efforts on that, and so together Bitcoin OpTech was launched as an initiative to try to federate and get some of the big consumers of block space to implement more efficient use of block space. So it's not exactly development, but it's clearly vital, and that has been great, and that continues to be, I think, a really positive force. And you should, if you want to follow, by the way, what's going on in Bitcoin development, read their newsletter. The Bitcoin OpTech newsletter is a fantastic resource. That was one. Then, in parallel, I said, well, where are the developers that that aren't already funded by the generosity of, say, the different companies I mentioned, and Alex and Suhas and so forth? Well, MIT DCI. So we support MIT DCI, who where some really key developers work, and that was the second thing. We also and an opportunity came up to sponsor directly one core developer, Meshkalider, Samuel Dobson, who's fantastic. He's doing his PhD and is based in New Zealand, and Alex actually reached out saying, "Do you know anybody who might be able to sponsor?" And I said, "Well, yeah, we'll do it." And it's fantastic. Samuel's amazing. And what else? We one of the things that we do support is Coin Center, to help communicate to government and regulators and so forth. I think it's a terrific organization. It's obviously not development. Another thing that we did, we had the opportunity, is really fantastic, to create some scholarships to send. Actually, we chose particularly to send female developers to Jimmy Song's programming Bitcoin.
That's a great
seminar.
program. Yeah.
And we're always on the lookout for high leverage ways to support with what we can do. And like I said, there are others who do even more. We do more than a lot of others, and I would always encourage everyone who has a stake in it and to give back. And this is a great way to do it. There's different ways, but particularly the development is a key one. There is, by the way, and I think the more diverse sources of funding we have for that, the better. The more decentralized that is. There is, interestingly, there is a valid school of thought, which is you don't want to perhaps overdo it, because one of the reasons why Bitcoin is such a great store of value is that it has a very stable protocol. And so you also probably don't want to, you don't want it to become perhaps you don't want to go overboard. But my guess is that we're still at a place where there's incrementally good opportunity, great opportunities to provide additional support, and there's spins on that. So we're not doing it, but say what the guys at Square Crypto are doing is distinct from, say, what the guys at Chaincode do and the guys at Blockstream do, and so forth, and the MIT DCI focus on. Specifically, what they're doing is sort of looking at it from a product management perspective, looking at how to improve the user experience and so forth. And I would just encourage anyone who's interested to think of things that are complementary and additive, and then contribute to those, either directly with their own time if they have the skills, or if, like me, you don't, financially.
This patronage model is definitely distinct from some other proposals that we're seeing out there with developer funds that are either being paid for through like token sale structures, right, or maybe a Zcash where you have the protocol itself, right, siphoning off rents to developers. We've already talked at length about kind of the outlook for a number of those protocols. And so, if they're not capturing much value, I guess that they're not going to be very useful in terms of funding developers. But I guess the question is, do you think that this funding mechanism that Bitcoin is employing, just kind of that has organically sprung up, is a sustainable funding mechanism for the long term?
So there's still important work to be done in terms of adding certain functionality to Bitcoin, perhaps some privacy improvements and so forth. But Bitcoin should actually, remember, I start from the point that the thing that matters from a value perspective is store of value, and the thing that makes something a store of value, one of the factors is the stability of the protocol. Yeah. And so it should tend to change less and less over time.
We should ossify at the base layer over time. Yeah.
Exactly. And so the answer to the question is, first of all, it is what it is. And secondly, I think, so kind of debating about, are there better systems is a little bit of a sterile debate at this point. It does have the benefit of being, again, it's sort of very resistant to centralization, because one of the problems of having some kind of a foundation or a central fund is that there's a there. Right. This has the benefit of being very decentralized. And again, I just, you're gonna have two opposing forces. Bitcoin is either, listen, in 10 years' time, Bitcoin is not going to be whatever price it is today, right? It's going to be worth not much or a lot more. That's just kind of the nature of the beast. And the implication of that is that you're going to have two opposing forces. One of which is the protocol should be changing less and less, but also, if it's still around, the value will be greater and greater, and therefore the sort of the burden of ongoing philanthropic support relative to the value that those who own Bitcoin will possess will be less and less.
Yeah.
So I'm not stressed about that.
And I guess it'll also move up the stack, right? We'll be funding things like layer 2.
Right, which
so-
which arguably could have their own like business models. I mean, so the base layer doesn't and can't, and and that's all. But yeah, I mean, let me say Lightning Labs, which we're shareholders in, and delighted with, is it's a business. It has aspirations to be a business.
So commercial kind of open source business models emerge as this system matures.
Certainly, at higher levels and so forth.
Yeah, the protocol funded rewards thing has been a particular animus of mine, because my view on that is it's very convenient, of course, especially for younger protocols where there is not such a significant base of patrons, for instance, or corporates which benefit from the existence of the project. But the trade-off is really extreme. I mean, not just centralization. I mean, I don't think we should be fetishizing decentralization for the sake of it, but the outcome of that is that you have this rentier class of developers, or maybe not, or administrators, which have a very strong interest in retaining that privilege, potentially at the expense of actually, good decisions. And it also kind of corrupts the feeling of neutrality, because now you have a privileged class that exists, explicitly deriving rewards from the protocol, and they may not make decisions that are in the best interest of the protocol at large. So
Agreed.
I think it's very easy for basically corruption to emerge, and for the equivalent of aid dependency to occur, which is the situation where an entity which has this nice money spigot ends up configuring itself to best exploit that, as opposed to doing what their mandate should be.
I agree. And by the way, you look at the top contributors to Bitcoin, core, over over the years, there's been a lot of change, and that's and there's some continuity, but also a lot of turnover. That's probably a good thing. I mean, it's probably healthy.
Right. It rebuts this claim that Bitcoin development is this closed elite where new developers cannot break in, which is probably the dominant view for people who don't really understand Bitcoin very well.
Yeah, chain code really did change the narrative on that.
Absolutely,
totally.
Really, like getting Newberry and Corallo involved.
And then they do this fantastic the residency where they help folks get engaged and as developers and so forth, and there's so many different things that these guys are and others. I mean, it's exciting to see all the different things that are happening, and I hope that there's incrementally more.
Yeah.
By the way, I wanted to come back to something, Nick, you mentioned earlier. This is now a little bit early in the conversation, but we were talking about proof of stake and then DeFi and all of this kind of stuff. Comment I was going to make is that in the same way that I don't think that means of exchange makes a store of value, or utility in sort of other respects is what makes something a store of value. I think that a lot of the stuff that's being built in terms of DeFi, particularly on Ethereum, I don't think is going to make ETH a store of value.
Right.
But I think
that's definitely the really popular narrative these days.
I don't think that makes sense, because for all the reasons that we've discussed in this conversation, I think that the fundamental reasons have to do with protocol stability, seizure resistance, and whatnot. If I had to, there's an idea I heard recently that I thought was very, very intriguing and sensible. Is that if Bitcoin continues to be the strongest store of value, a lot of what's happening in sort of the experimentation around DeFi is a bit of a sandbox, and ultimately somehow will probably migrate to the dominant store of value. So I think that stuff is kind of it's something that I'm going to spend a bit more time in terms of understanding. But from that perspective, just trying to think about what's happening that sometime in the future, the stuff that's good out of that and that works out of that might actually migrate over. and how that would happen.
The interesting thing is that you mentioned about the native unit not necessarily being the preferred unit to transact in.
Right.
That is certainly, there have been efforts to incorporate Bitcoin into DeFi through, various forms of wrapped Bitcoin and so on, which admittedly are quite clunky. But you can see how at maturity, something like Ethereum might ultimately resemble more of a side chain where you have units of Bitcoin which are inserted into the Ethereum system, which maybe allows for more expressive contracts. Although the issue there is that if ETH itself is not valued, then the system has little security.
Yeah.
So then the security model has to probably, if I had to guess, would end up looking like a consortium of for instance, exchanges that take turns signing blocks. But I could certainly see that being the outcome here.
Right.
The persistence of Ethereum, maybe the compromise on, on the decentralization in order to retain security if the system isn't valued very highly.
Right.
I think that, if you look at proof of stake systems, they almost invariably fall into checkpointing, basically single authority signing blocks, or cartelization with EOS, which again is a very small number of entities signing blocks. To me, that's what proof of stake is. It's a way to distribute authority. But if the coins were distributed in a permissioned way, then the authority is permission in the first place. So the challenge is to find a way to distribute the coins such that proof of stake, retains its distributed nature. But proof of stake is kind of inherently concentrative.
Right.
It's quite difficult to stake. On Ethereum, it's actually, the designers are making it deliberately difficult. So my guess is that people just deposit their coins into Coinbase and they let Coinbase stake on their behalf. Then Coinbase and Binance end up having all the authority in the system.
Right.
And we've really achieved nothing at that point.
So it's kind of like these giant ETFs that have all these votes in companies.
I don't think these systems will die. I think they will just become permissioned, and the stakeholders will accept that because the alternative is death.
Right.
So we've gone in the weeds here, and I'm cognizant that you're someone that's able to go in the weeds, but you also must be having a lot of conversations with traditional asset allocators on just how to think about this space. And so, how do you explain this?
Maybe just a general comment. I'm first and foremost an investor, and this isn't my day job, right? It's not where I spend most of my time. So one of the things that I have tried to communicate a little bit around is to others who don't sort of live and breathe this, how they should think about it as an investment. And I think and frankly, it's very consistent with what Vince has first told me, on that first day, which is, I think for, what I often tell people is, and these are people who are thinking about whether they should invest and so forth, is I think, look, it is sensible for everyone, I think, to own a little Bitcoin, and it's not sensible for anyone to own a lot. It's a risky venture capital bet. I think it's a really interesting one, but it should be part of a portfolio. It's in the same way that all of our venture capital bets are risky, and probably most of them will fail, and a few of them hopefully will win big, and that works out to a sensible investment strategy and portfolio. And I think it's important to sort of approach it in the same way. And so I encourage people to think about it in terms of investing what they're prepared to lose, because they could, and sort of ask themselves, given their own risk tolerance, but the two opposing questions, which is if it failed and went to zero tomorrow, what could I sort of live with as a loss? But on the flip side, if it does turn out that it works, and it works in the sense that it becomes this non-sovereign monetary store of value, and therefore much more valuable than it is today. You're not going to look back and say, well, what a schmuck, I should have owned more. Right. And then just go invest that amount of money, and not focus too much on the price and the timing and all of that. So very clearly not a trading approach. I see it again. I'm inspired by how we invest in venture capital. When we're looking at a deal, of course, valuation matters. On the flip side, whether the pre-money value is 8 million or 10 million is 8 million is better than 10, but if it's 10, does that suddenly become a bad deal? And I think it's important to kind of look at this in the same way. It's much more important to focus on position sizing than price. And then it's important to come in and just say, look, you know what? I'm not going to do, no matter what happens, I'm not going to do anything for a while, and a while being measured in years, not days, weeks, or months. And that's kind of how I think people should think about it. I would also add that, and I mentioned this, in my paper, or other things that I've commented on. I personally think that the notion of diversifying inside of crypto I think it's a pointless. It's pointless in its essence, in that, when we invest in say venture, right? We don't say, okay, we want to, we want to invest in a portfolio of enterprise software companies because we just want to be sure that that whichever one is successful, we capture. I mean, we don't you don't sort of approach that way. You say, well, which one, if it's successful, should do I think is going to be valuable to me as an investor, and make that bet, and then diversify the risk around that bet by having a sensible portfolio of very different other assets. And I think the same thing, so yes, invest in Bitcoin. I think for most people, that's a low single-digit percentage of assets. And then, diversify. And the reason I say Bitcoin again is because by construction, if Bitcoin succeeds in what it's trying to do and what it's trying to be, it will be valuable, which I don't think is the case for everything else. Then go and invest the rest of your portfolio in private equity and public equity and in all kinds of other kinds of venture, other assets, and accept the fact that there's a chance that it turns out that it's that it's neither Bitcoin nor a fork of Bitcoin, a future fork that succeeds, but that's no different than the fact that I know there are going to be successful, tech companies coming out of Silicon Valley that we didn't invest in. I don't lose a lot of sleep over that. I'd like to, but it's impossible to capture everything, and so I don't worry about that. And I only mention that because that's I'm speaking. That's what I am as an investor. So I think it's important to kind of put it in the context of how we see it. And we get together and talk about this kind of stuff. It's fascinating. We get into all the ins and outs, but and also fundamentally, I tell most like my sort of normie friends, actually kind of discourage them. There's an interesting reflex, which is people say, well, I'll talk to them. They'll be like, well, okay, I'm going to go read about it and really get my really understand it, and then I'll invest.
Just like how you invest in IBM, right?
Well, that, or even more, I would say even beyond that, right? It's like you get a deck on some biotech deal. You don't go and say, well, okay, first I'm going to get a PhD in genetics. You make a decision and you express your lack of certainty through the position size. You don't become an expert in everything. And so I also encourage mainstream investors to not, they should do what I did, which was ready, fire, aim. I strongly think that Bitcoin is the right thing to do within the space, right? So focus on your position size, go do it. and then learn if you want, but you don't necessarily have to be an expert in this. And the same, we all have exposures to things that we don't fully understand. We understand enough, but we don't fully understand. And provided we have a sensible, balanced portfolio, that's okay.
Which of the potential attack vectors against Bitcoin do you find to be the scariest? Or not just attack vectors, but failure modes?
Yeah. So listen, if Bitcoin faced no risks, right? If there were no risks of failure, it would already be worth $1 million or whatever, right? So the fact that there are risks is actually what is part of what makes it an interesting investment. And let me just make a comment on that. There's this kind of there's this kind of question that gets asked about, well, but it's not it's too volatile to be a store of value, or is it a risk on or risk off asset? And I don't understand. This is actually, to me, very simple, right? And I'll get to the minute to what I think are the threats, but let me just comment on this as an investor. This is like a Series B early stage tech investment that almost inconveniently happens to be traded 24/7, right? Sort of in a distracting way, that aspires to become this digital gold, right? It is not yet digital gold. And if it were, it would already be worth a lot more, and there wouldn't be the same upside. So if you invest in it today, you're investing in it because you see, because you're basically betting on that upside. And there will be a phase transition, during this process. It'll be a phase shift from a risk asset to risk on asset to a risk off asset. And that seems to me to be very very basic and intuitive, and therefore the fact that there are risks explain why it's worth what it is. I would also say that since 2016, when we first invested, my perception of the risks has declined much more than the price has increased, right? So if I think today on a risk reward basis, it's even more attractive than it was in 2016, because I think back in 2016, I perceive, I think there were more threats than, that those have been mitigated and so forth, to a greater extent than the price has gone up, right? And so I think it's even more compelling in many ways as an investment today, notwithstanding the fact that it's obviously whatever it is, 15x or something from then.
With the main risk off events being UASF 2x.
There was, but also listen, there was there was this explosion of altcoins. There was this whole kind of, so when I started out in 2016, I hadn't even begun to think about the whether Ethereum and all these other things were a threat, whether there was going to be a whether what did matter was, I didn't even, there's there's so many other things that were out there, and also we've got 3 more years of it just being there, under our belts. We've got 3 more years of it still there. It's funny. I was having this conversation with a normie friend, and he said, yeah, Bitcoin's still there. I'm like, yeah, it's still there. And that's really important. So I just, that was just a comment. But so I think the fact that there are risks is, again, in the world, we're in venture capital mode when we're talking about all of this and thinking about all of this. It is the presence of those risks that make it, in fact, such an exciting, potentially interesting investment. So what do I worry about? One thing I worry about is maybe apathy, and maybe apathy is not the right way to say it, but we're in a period of time which has happened in the past, and they'll maybe repeat in the future, where incremental interest in it may have waned, and the pace of the pace of adoption and so forth, at least in terms of people just new buyers and so forth, perhaps has slowed. That there has to be catalysts for more people to see its utility as a store of value, and acting on that. I think that so historically that's always happened, and I don't know what it's going to be, but that has to happen. I think there's clearly some. I personally don't. I'm not too worried about sort of regulatory risks and state attacks, and so forth. Though there's always some risk, and I do think it's a given that, and we are it's already the case, and I have no personal objections to it because we're an institutional family office, and so compliant in every jurisdiction and all of that. So yeah, on ramps and off ramps are KYC'd and so forth, and I don't personally object to that. But I think that.
I think the point is there that if Bitcoin were to become like fully surveilled and KYC'd, then it would defeat the purpose of Bitcoin existing, basically. In that the teleology of Bitcoin is that it enables people to resist authority, resist the state, and so on.
Listen, I understand that. I'm as someone who comes to this as an investor and as opposed to coming in from an idea. So I agree. I'm somewhat less concerned about that. And don't get me wrong. If we can then have a separate discussion of the importance of what you just said, and I'm not saying I disagree with that. I'm just saying is the reality is investors like us, that's not a feature that matters, and institutional investors in general, to the extent more and more institutionally sort of institutional type investors come in, that's just not relevant to why they're investing in it. Which I'm not trying to argue with the importance of what you just said.
I would say Russian institutional investors might care about that, right? The ability to potentially, leave the country with your assets intact and so on.
Well, yeah, fair enough. Do I worry a little bit? I worry about, could there be some kind of unintended consequences of regulation and so forth? But I don't. That's not. So that's a concern. It is a concern, and if there weren't that concern, Bitcoin's price would be higher. So that's going to be part of the process. One thing that I think is, there's always the potential of a bug.
Yep.
And so one of the things, by the way, that the folks at MIT DCI are focusing on is improving,
security audits,
security and audits around commits and so forth. I think that's super important. Yeah. I think we're getting better and better, and one of the benefits of being involved in sponsoring development is I get to see and hear what's going on, and so I personally am really, I think the direction of travel is great in that regard, but that's clearly a risk now. It's been 10 years, and it's it's a massive bug bounty, and it's still there, and so every day that there isn't a problem is actually very positive news, but that's a risk. Quantum. So someday that could, that'll be an issue. It's probably quite a number of years off, even though I suspect that, the world the mainstream is probably underestimating how soon we'll have, sort of how quickly the power, sort of quantum computing power will develop. Realistically, it's, my guess is personally, it's like at least a decade before that becomes an issue. It'll have to be solved at some point. But it's not even clear exactly what the issue to be solved is yet. I mean, there's a lot of complexity around that. So do I worry about that today? I have worried about it enough to think about it and come to the conclusion that no, I don't worry about it that much. One of the things that you talked about, the security model, I mean, I personally think that I'm not of a view that the cost of attack has to increase linearly with the value in order for it to be secure. I mean, I think that there is some convexity to this. And I think that there's there's a point where the cost of attack is high enough to be enough.
Yeah. I call that the threshold model of security.
And
there's some threshold where it's effectively secure.
And I tend to subscribe to that. So therefore, I'm not too worried about this kind of reductionist view that, well, it sort of it's going to get unbearably expensive as the value goes. I think that will increasingly perhaps disconnect. I mean, there's an argument we probably have much more security than we even need today. So there's probably some, it's probably viable for it to decline. I do personally, and this is a very controversial thing in this space. I think that this transition of the cost of security being borne by holders, right, shifting over time to the cost of security being borne by transactors, is, given everything that we know today, and a decade more than a decade down the line, is probably not intuitively ideal. You would ideally probably like to see both holders and transactors sharing the cost of security, always, just at an intuitive level. And the rationale is just to say, it just seems to me to be intuitive to say it's more stable. The system is more stable if both types of users are sharing in that cost, as opposed to just one type of user, right? And
although the response to that might be that actually holders, by definition, are transactors. They have to have transacted.
No, but the frequency, the whole point is the frequency is very low. One of the reasons I don't worry about that is, I'm going to choose my words carefully because I know that this is a controversial thing in the Bitcoin space. Let's just hypothesize for a moment that at some point it becomes necessary, or at least there's a school of thought that emerges that it would be useful to create some ongoing inflationary block reward to share the cost, right? That's obviously unthinkable today, and that's fine. What I love about the nature of Bitcoin is that it doesn't matter what I think per se, or even if whether or not that actually is necessary. If something like that it becomes necessary, right? It will happen in the sense that what will happen is at some point there will be a disagreement, right? That'll probably be expressed through some fork, right? And that will tell us what's Bitcoin, right? And if Bitcoin is, if the conclusion of that is Bitcoin, it's absolutely, zero change, it's, 21 million Bitcoin forever, then that will answer the question. And if the result of that is, well, now we have 1% inflation forever, and please don't, I'm not advocating, I'm just saying if that were the case, then that will be Bitcoin. And one of the things that I love as an owner, as an investor in Bitcoin, is that property is pretty amazing. You can't invest in a company and say, well, I know that if there's a strategic fork in the road, that no matter what happens, when I say no, it's a slightly, those are maybe words that are a bit too absolutist, but that I can be highly confident that the company will simply pursue both strategies in parallel, and it will, and the dominant strategy will win, and I'll end up, because I own both, I know I'll be able to participate in both of those futures. It's a fascinating property to me that as an investor, there are issues. Quantum, risk might be another one where there might be, there might be a solution to that people disagree over. There might be more than one posited solutions when the time comes. If I own Bitcoin, I will own each of those, and we'll quickly find out which one is the right answer. And I think that's a fantastic risk mitigating property of Bitcoin.
So by owning the original, you own the descendants. You
Right.
have a claim on the descendants too.
and that's why one of the things I often say is, I'll often kind of qualify. I'll say that I think that, there's a high likelihood that the winning store of value candidate is going to be Bitcoin, and I'll quickly add, or a future fork of Bitcoin. And I want to be clear, a future fork, not a past fork. But that's I think it's just an incredibly powerful property as an investor, and something kind of unique. And people don't maybe think about that enough. When I talk to potential investors, people who are new to the space, and the problem is that to get to that understanding, you got to go through a lot of other steps. But they worry about these risks, and I'm kind of like, yeah, but it'll sort itself out. But yeah, but then that means it's not scarce. It's like, no, you don't understand. There will always only be one Bitcoin, but it's sort of an emergent thing as to what Bitcoin is.
So I totally disagree with that.
Ah, great.
Yeah. So I think so it's useful to me to think about, to disaggregate Bitcoin into its two constituent parts. So the property set, so the list of who owns what, and then the rules for making alterations to the ledger, right? So the rules of the protocol, and then the property registry is the UTXO set, right? And I think there is something. So I think the UTXO set is basically always likely to persist, but as you say, it might be forked, or there might be an airdrop if we realize that the current trajectory is impossible. And I think it'd probably be the Bitcoin developers themselves that would be coordinating that, which would give it the authority. Mm-hmm. So if we had to switch to a new system, that would be possible, because collectively the developers would say, yeah, okay, we need to, God forbid, add inflation or do something else. What I disagree with, I don't think the inflationary system would be called Bitcoin. I think it would have to have a new name, because I think there is something essential in Bitcoin's ontology, which is that Bitcoin is a thing as stipulated by Satoshi in 2009, which is 21 million units. So if you were to alter that, maybe that's fine. Like, maybe the Bitcoiners collectively say, like, yeah, fine. Look, Satoshi's idea, it didn't work. But I don't think you can call that Bitcoin, because Satoshi named his 21 million unit creation Bitcoin, and that 21 million unit, thing is so essential in that instantiation of the system that I think if you do have this compromise and shift over to a new one, you have to call it something else.
So I guess there's a couple things there, though. So from an investor perspective, all you'd really care about is the UTXO set, right?
Yeah. Oh, I mean, like, the property John is talking about is totally, it's secure. So you do get access because there's such a strong incentive among everybody in this community to retain the property registry, for sure. I'm making a somewhat pedantic point about the
strict interpretation of the literature, I guess.
I'm not even saying the literature. I don't believe that this specification was never written down. Like, the white paper doesn't say what the supply cap is, right? The supply cap is found in the code. So what I'm saying is there's an unwritten specification of Bitcoin which existed in Satoshi's mind, which we can cobble together from the white paper, from the code, from his Bitcoin talk posts. It's like the British Constitution, right? It doesn't exist in any one place. And that was the essence of the system as instantiated in 2009.
Doesn't that leave you open to a lot of rebuttals around things that have changed, though, like the block size?
But to me, the block size isn't really that essential. It's just like an implementation detail. Like, the original block size.
But that's your subjective. You're saying one thing is essential and other thing's not.
Yeah, absolutely. Yeah, I'm asserting that. Yeah. So, like, to me, the block size is totally, I mean, it's important that we keep it capped, actually. But Satoshi's first block size due to a bug in the code was 500 kilobytes, not even 1 megabyte.
And subsequently uncapped.
And now, well, no, it's not uncapped.
No, subsequently it was uncapped, and then it was recapped at 1.
Well, there's like some history there, but yeah, like now it's 2.4 megabytes.
Yeah.
But like, clearly the Bitcoin developers thought it was okay to change that parameter. I don't think Satoshi envisioned that as being an essential point. That's just like, how do you achieve spam protection?
I'm just gonna sit here and throw darts if I continue.
No, but so we'll agree to disagree. I mean, I'm not.
I think it would be very convenient to have this continuity, but I I don't think that is the right interpretation of Bitcoin's ontology.
Yeah, well, okay, fair enough. But what's nice is that what you think doesn't matter in the same way that what I think doesn't matter, in that it'll just happen, and that's the point I was trying to make is fair enough, right? And I mean, and I'm not suggesting what each of us thinks, what any owner of Bitcoin thinks doesn't quote matter. Because it has this, this sort of emergent property, right? And my point was not to maybe get into, I very carefully avoided suggesting that I'm advocating for one or the other. I'm acknowledging that an issue might exist on that front, and that that there are different possible solutions, and that could be one. But more use that as you're saying that's an issue. Hasn't we don't know how that's going to play out. It might turn out it's not an issue, but it could be. And I'm using that as more of as an example of something to highlight what I think is this incredible property that from an investment perspective, people don't think and talk about enough. Right. And I just think that's, and I just want to make that point. I just think it's really,
I think you're absolutely right. I think you're absolutely right. All I'm asserting is that if there is a continuity break that is so significant as to alter the supply schedule, it's likely that the new entity, even though the UTXO set is essentially retained, is probably considered to be something distinct from the original. And so, we have a real world example of this. Ethereum 2.0 is 100% different from Ethereum. It has nothing in common with it. But the Ethereum community is, comfortable enough to admit that, they need a full rewrite, but they still want to retain the same property registry they've been working on. So they're porting over the account set. They don't have UTXOs, but they're porting over the account set, and then they're going to be adding completely new rules for transacting on Ethereum. And in my opinion, ETH 2, lots of Ethereum people have said this too, Ethereum 2, basically, the only thing it has in common with Ethereum is that it's called Ethereum, but it's basically a new system. It's a full from scratch rewrite almost. So that it actually, I think, is a model. It's a model for Bitcoin.
Yeah. I think that's interesting, and it's also true. I think it's somewhat different. I'm talking about, well, okay, fair enough. I mean, it's the same UTXO set. I think that's the common ground.
The point is that they retained the property registry, totally re-architected everything else.
Yeah, fair enough. But I just think to a layperson, the notion that it can be forked is often sort of seen as this negative, and it seems it kind of undermines the notion of scarcity, because you're kind of creating as many of these things as you want, which I think is a fundamental misapprehension of that thing, in that it's not only not undermining scarcity, because there's kind of there'll always be one that ends up emerging as, and I'm going to go against your grain, Nick, and call it Bitcoin, and we've seen that, and I think that will always continue to happen. And so it doesn't undermine scarcity, right? I think it's just a miscomprehension, and by a lot of people in the space, or people who aren't in the space, who look at it and are aware that there are forks, and think that means that the notion of there being a fixed supply is or known supply is undermined. But the second thing is that I think it's seen as a negative characteristic, and it's so much a feature as opposed to a bug. That is the point I'm trying to make. And in a way that's vastly risk reducing. So, we think about, we were talking earlier about the fact that the reason it's only, it's only worth whatever it's worth today, is because there's a lot of, there's still a lot of risk. One of the reasons I own it is because I perceive that the risks are much lower than are implied by the price.
Yeah.
And one of the reasons why I perceive the risks is lower is, amongst other reasons, but one of them is the fact that Bitcoin has this unique property that makes it very, very resilient to existential threat. Through the ability, sort of internal existential threat, right? I'm not talking about, exogenous threats of regulators and whatever. I'm talking about things to do with either the rules or the code or whatever. Right. It has this property which allows it to survive,
right,
and address that.
Because in your view, the thing which is Bitcoin is simply the list of the balances, right?
Well,
and it's very hard to erase a list of 60 million entries in a database.
Well, there's that, and then kind of the one therefore that emerges from that is having the highest value, right? And that we all then, we kind of the great, the grand we collectively say this is the thing that we think is money, that we think is a store of value. So that, I don't know, I just think it's a fascinating property that doesn't get talked about enough.
So you have nothing to sell. Usually we have people that are like,
no.
Go to our website.
Fact,
or
one thing I would say, one thing I would say is, everybody should, people who, especially newcomers to the space, one of the things you should do is think about the motivations of the person who wrote what you're reading or that you're listening to, and apply, an appropriate level of skepticism, because the reality is almost all of so many of the voices in the space, the people who actually, are likely to be read or heard, do have something to sell. And one of the, whatever you think of my opinions, I at least am aligned with anyone else in the sense that I just, we're just investing our own money and have to, and try to come up with the best view and have no interest apart from that. And I, I think that, means that maybe at least there's an alignment of interest, and whether or not that means I'm automatically right, at least there's that.
So John, you've been very generous with your time. This has been one of my favorite episodes. Can't wait to hear what it comes out as live, and let's go get some steak.
Great.
Thanks, John.
Thanks.